So you've got a sort of toolkit available to you when you're thinking about how to manage your risk as a business. And I caught the end of Kevin's talk earlier on, from which it's quite clear that your contract always sits right at the centre of what that toolkit is able to provide. But next to that sits your PI insurance product. Your contract obviously dictates the extent of your liability, and then all being well, you will transfer a sensible amount of risk away from that contract onto your insurers, and your PI policy is the means by which you do that. I've called this professional indemnity a long-tailed animal, because the theme that I want to try and draw out is to look at some developments in the PI market at the moment, the insurance market, and then look at some developments in your own trading environment, and then look at where there are actually gaps between the two, but how that might not be apparent today. It'll only be apparent when you come to call on your policy in a few years' time. When we talk about long-tail business, that's a technical term, believe it or not, in the insurance world, and it refers to whether or not an insurer can expect to part with his money during the lifetime of the policy or sometime after it expires. And professional indemnity, certainly for construction professionals, is very much in the latter of those two categories, added to which, when you notify your insurers of something that's gone wrong, it's very often something that went wrong a number of years previously, so the tail is longer again. I can make a guess of what you think of your insurers, but what do they think of you? Well, in terms of a risk profile, what they're seeing and what we're seeing as people who advise you in placing your policies is that you are always being asked to do more for less under increasingly onerous contracts, as we've heard. This is a little diagram about what the risk management process should involve. And I'm putting that right up there because I'm talking here about contracts being the means by which risk is distributed between the parties. I'm employing you to do a job. If X, Y, and Z goes wrong, then I pay for it, but I want you to be responsible if A, B, C, or D goes wrong. That's the way that's what a contract does. And it should happen by way of a process of identifying what the risks are, analysing them, evaluating how big they are, the likelihood of them arising then. And the control section is really the central bit about what are we going to do with those risks, having identified them. And I think sometimes employers think that they know what they're doing, but they're not actually very good at considering which party is best placed to control the risks that they've identified. They're not very good at thinking about whether or not you, as the consultants that they're trying to dump risks on you, have the financial capacity to in fact absorb those losses. And then they don't really think about whether they're achieving what they think they're achieving, which is to transfer the risk at all, because the reality is they end up retaining more of it than they think. So just drilling down into some of those questions, when we're talking about your ability to control risks, we're talking about employers placing you under obligations which in reality are outside your control because they relate to things that other parties might be doing. Joint and several liability is a huge theme for us at the moment, and I'll come back to this in a little bit more detail later on. But I say they don't think about your ability to absorb loss. They forget the fact that you are entirely reliant on PI insurance when something does go wrong, because consultants don't tend to have much by way of cash assets or physical assets in the building. It'll be the policy or nothing else. So if the policy doesn't respond, then they haven't done what they thought they were going to do, what they thought they were doing when they were contracting those risks out to you. So the whole way that they're dealing with risk is fundamentally flawed, and that has an impact on the way that the PI market responds to this and how it can respond to these exposures. I've talked about risk dumping, and we review about 8,000 to 10,000 draft appointment agreements every year on behalf of our consultant clients. We're giving advice on what's a sensible risk to accept, what's a totally unacceptable risk, what's uninsurable, that sort of thing. And the sort of themes that we see in these contracts that we're reviewing will be, I think Kevin touched on a lot of these earlier on about what they involve. It's asking you to do things that they shouldn't reasonably be requiring of you, asking you to agree to indemnities, asking you to accept unlimited liability, and so forth. I mentioned joint and several liability, which is this weird legal fiction that we have in this jurisdiction and elsewhere. And it's the doctrine by which if two or more parties are liable to the same claimant for the same loss, then that claimant can sue all of them together, or it can sue only one of them and recover the entire loss from him. So it has obvious significance in the context of construction contracts, where under a traditional procurement model anyway, a structural engineer will be sitting alongside a contractor and maybe a project manager and whoever else it might be, all working for the same client. If something goes wrong, the client can sue any one of you, depending on what your contract says, if you've all contributed to the same loss. It's then up to you, as the unfortunate defendant who's been singled out, to claim a contribution from any other responsible parties that you think should equitably make a contribution. And that presupposes, well, that there is a cost associated with that, and there are risks associated with doing that, because you might not get any money at all if the judge just doesn't agree with you. And very often the risks will outweigh the costs of going to court on that, and so that the money just ends up sticking on your claims record rather than where it should equitably land. And all of that, of course, presupposes that these other culpable parties are still in business, that they're still there to sue, they're still there for you to go and ask them for a contribution at the relevant time. And in an environment where we've seen contractors going under, occasionally consultants have gone under as well, that certainly isn't something that we can take for granted. And one of the themes that we're seeing is that structural engineers, as the firms who have survived the storm of the recession and who have generally got pretty good insurance products behind them, tend to end up paying far more than their fair share of it. So just talking about these sample clauses again, this is the sort of things that we come across, and I'm sure it's obvious that the offending wording is in orange. Why you shouldn't be agreeing to do all those things. These are all things which are outside your control. They refer to physical matters rather than the things that you're doing in your own office. They refer to the end product. They refer to quality of materials and so forth. So what do insurers think of that? Well, they will respond to it. The insurers won't just sit there year in, year out and accept risks being dumped onto you and then you dumping that back on the insurers through this through this chain, because they have to protect their position. So what's happening in the PI market? Well, ironically, the higher your indemnity limit, the higher the claims will be as well. The best insured consultants tend to be those that attract the highest claims, unless they then limit their liability in contract, unless they take the various risk management measures that we've advised them to do. We're seeing an increase in demands for ever higher limits of indemnity. Local authorities are particularly good at that. Certain types of contractor are very keen on that. But if you compare the position now with what it was 5 years ago, 10 years ago, there's a very easily identifiable trend there. Has cost implications for you, obviously, now and in the future, because, as you probably know, you have to then maintain that higher limit of indemnity for as long as you might be sued for anything in connection with that contract. That's probably what you've promised to do in your appointment agreement. At the same time, we're seeing an excess supply of capital in the market. More and more investors plough their money into the insurance market in the hope that that enables insurers to go and underwrite risks and satisfy their regulatory obligations in the process, and then cream off a profit, having paid out the claims, which hopefully were less than the premium sums that they collected in. So there's a lot of capital going into the market all the time. And what that leads to is a dog-eat-dog competition situation between insurers. They're all undercutting each other on price. That means that they then start underfunding risks, and that then leads to real problems with them pulling out of the market. Nobody likes paying PI premiums, but where we see insurers being underfunded, that leads to real difficulties. What sort of difficulties does it do? Have I pressed the wrong one again? I haven't. There we go. So I talked about the changing face of the market. Some insurers are pulling out altogether, which is not a very enviable position for you to be in. If you've built up a bank of money with one insurer over a period of years, and then all of a sudden that insurer decides he's not interested in engineers anymore, if you've got claims outstanding with that insurer, it's not a great place for you to be in, because he's probably just looking to limit his loss. He's not interested in his relationship with you at all going forward. We're finding insurers coming up with new ways to avoid making losses. They come up with new ideas about how they can write products in a way that satisfies the regulators, but just isn't putting enough money into the pot. They start giving brokers like ourselves, not that we do this, delegated authority to decide what premium they're going to charge, which is not is not the way that it should work, because that's not what underwriting is about. There's a lot more scrutiny of individual risks. So you may find that as you're applying for your policy renewal year in, year out, you're having to answer more questions. You're having to demonstrate more that you are going to lengths to manage the risks that you've got. They're interested in, are you negotiating contracts properly? What sort of work are you doing? How do you go about doing it? How many jobs do you turn away in the course of a year, and why? Do you know when the time is to walk away from something that doesn't look right? We're also seeing insurers withdrawing from certain sectors, and they're saying we won't cover wind farms going forward. We're not interested in covering biomass projects going forward. We won't do this, we won't do that. We won't do basements, or if we are doing basements, then your excess, which would have been £5,000, is £20,000, because we just find we're making crashing losses on that. And frankly, we're not going to tell you that you can't do it, but we don't want you to do it, because it all ends up back in our court. And we also see restrictions on contractual liability. These aren't extracts from policies that we place, but we've seen these in the marketplace from our competitors. And this is insurers essentially saying, two different wordings that say the same thing. Insurers essentially saying that they won't cover you in the event that you incur a claim in contract that you wouldn't have incurred in tort. So if you agree to something in a contract and you say, yes, if this goes wrong, I will pay you and I'm liable for damages, which is what you all do all the time, and even the ACE conditions say that. Under this policy wording, that any claims under those clauses would not be covered unless you can also show that even if you'd just been sued in negligence, and even if you hadn't agreed to that wording, then you still would have been liable. So it really is a roll of a dice, because you're never in a position at the time of signing the contract to know what is that's going to go wrong, and to know how that clause would affect your uninsured exposure. So uninsured exposures is exactly what we're seeing. We're seeing an increasing number of enquiries as brokers from distressed risks, as they're called, i.e. in lay terms, engineers who can't find insurance elsewhere, engineers who are finding that their insurers have whacked their premium up. I've come across one example. The annual premium was around £7,000 year in, year out, and then it went up to £95,000 2 days before renewal, because an insurer over there decided that he really didn't like structural engineers anymore. And that's the sort of position that these guys are finding themselves in. They find themselves realising that there are gaps in the cover. They find that they're having to fight with insurers to get their claims paid, because insurers are getting better at finding ways of wriggling out of their obligations, despite the efforts of regulators and so forth to tighten up on that sort of thing. But that has much wider implications than just for individual firms. It has implications for the future availability of and the costs of PI and the sustainability of the wider market. So, with all that in mind, I think it's quite clear that when you're making choices about where you're going to place your PI, you have to think very carefully. We need to make sure that the cover is sufficiently robust to avoid any gaps arising, but that's not just, we don't just do that as brokers and nothing else, nor do we just go around shopping around for the cheapest premiums. Any idiot can do that. Instead, what we have to do, and what we see as being our role, is understanding insurer behaviour, trying to understand where this insurer who is saying what he's saying today is going to be in 5 years' time, when there will still be claims outstanding under policies that had claims against them reported today. If we go back to 2001, when the independent insurance company failed, that prompted a study by a group of actuaries who identified some common traits, common behavioural traits in independent, and which then subsequently came up again when Quinn Insurance went bust a few years later. And I'm not going to talk through all of those, because time is tight, and if anything, we're trying to sort of catch up in this session. But over-reliance on reinsurance, for example. Insurance companies don't just pay your claims out of the premiums that they've collected and hope that there's enough money to make a profit at the end. They reinsure sections of the risk onto other specialist reinsurance companies, so that if you blow a hole out of my premium pot with your big basement claim, I can at least recover some of that from a reinsurance company who might have taken 20%, 40% of the risk. That's fine up to a point, but it should never be an excuse for me just underfunding my risk in the first place by setting premium levels that are simply too low. It's about insurers trying to grow too quickly. It's about them entering new areas where they don't have any underwriting data and where they don't really necessarily understand what it is that structural engineers do. They might understand the core duties, but do they understand all the bits around the edge? And do they understand why working in Ireland, for example, might be more risky than working in Chelmsford? It's all sort of relevant, because unless they've got that information available to them, they won't know how to price it sensibly. So that's what we do as brokers. We try to identify the way that insurers behave, and then hopefully if we're doing our job properly, we won't be recommending products to you that are being offered by insurers that fit into those categories. So to illustrate why that's important, I'm going to give you an example of a claim that was reported to us back in 2002. Details of this are largely irrelevant, but suffice to say that it concerned a fatality on site, and then there were civil and criminal proceedings following that. The timeline is pretty obvious. So PI cover was placed in 2001, and you can see the various events. The accident occurred only 6 months later, actually. And then you can see various events took place between then and the file finally closing in 2012, when after we'd succeeded in winning at trial and we got most of our costs back. But even that took a period of 2 or 3 years towards the end. Throughout that whole period, we needed the support of our insurers, and thankfully we got it, because the insurers writing business in 2001 were still interested in supporting consulting engineers in 2012 and still wanted to have a relationship with this engineer going forward. But all of that was only possible because we'd made the right decision right at the start of that slope about where to place cover. So the point, hopefully, is a very obvious one at its most fundamental. And that is that the decisions that you take at each of your renewals can be absolutely fundamental to the longer term future of your business. And it's the same, obviously, in connection with the contract terms that you're being asked to sign. What might look slightly innocuous now, or what might look like a risk that you're simply willing to take on a commercial basis, which you have to do anyway, might not be quite so attractive when the cover isn't available in the market a few years down the line, or it might not be attractive when the problem only occurs 2 years later after you've signed your contract. So that was my ongoing theme in this talk, is just to get used to thinking in the longer term and thinking about what just protects your shorter term interests. I can't stand here and tell you how to be better engineers. We can talk a lot about the legal issues, we can talk about what's a good thing to have in your agreement and so forth, and we can talk a little bit about project selection, what are the risky areas that are causing insurers a headache at the moment. But in terms of just running your practice well and avoiding errors from creeping in, I would simply say that it is very often about doing the simple things well. Conversely, I've seen so many very high value claims going well into 7 figures arising out of what I would think are relatively simple mistakes. So it's things like somebody doing some calculations and they press the 0 button once more than they should do. It's things like people copying one set of details from this drawing onto another drawing there, and just human error means that something happens in that transfer process so that an error creeps in. It's about the loads changing at some point because the client has changed his mind about what he wants. You do your bit perfectly well, but you just don't pass that information down to everybody else who needs to know, or possibly not even to everybody within your own office who needs to know that. So they're tiny things that then lead to very expensive claims, in my experience. So risk management at its simple is precisely just about finding ways to stop that from happening. Easier said than done, and I understand that. But this is also why contracts are so important. If you accept that at some point in your career you are likely to have some sort of a problem, it may only be worth 200 quid or it may be worth 2 million quid. You just don't know. Something is going to go wrong. But if your contract is written on favourable terms, then obviously you have at least some chance of defeating that, or of minimising the damage and of mitigating the loss. So if you can use standard forms, as Kevin was saying earlier, then that's great. But as somebody in the audience was saying, that never seems to happen without it being changed in at least some respect. A huge part of this is about valuing what you do, and about what you bring to the industry, and about not being pressured by your clients into accepting last-minute changes and having to rework your design for no additional fee. Because the moment you're doing that, you spent 2 weeks developing something, and then you've got 1 day to change the last bit of it. What you're doing in that 1 day won't be subject to all the checks, the balances, the risk management procedures, and all the usual sort of whatever it is that you do in your office that you managed to operate in the previous couple of weeks' work. Again, easy for me to say that, but you don't have to take my word for it. Just to share some thoughts from others. This is the 2015 European CEOs Conference. There's a risk of engineering becoming a game of chance. Those responsible for the procurement seem determined to push risk down the line onto the smallest guy at the bottom. We can't accept risk that is through the roof when the rewards are through the floor. Sound familiar? How can we match a collaborative approach with an adversarial system? Collaboration's great, we all like it, but the moment something goes wrong, that's when it's tested. When it does go wrong, everybody retreats back into their own silos, they report it to their insurers, the insurers appoint lawyers, and collaboration is just something that is long forgotten. Bad things happen to good companies. Don't assume that because you're good at what you do, i.e. the engineering bit, you won't face risk. You have to build in a culture of resilience. Be prepared. The biggest threat to the engineering profession, says one other person, is a lack of commercial focus, getting that balance between risk and reward. We ran a series of roundtable events where we thought we'd be interesting to get mostly clients, but some non-clients as well, round the table to tell us what they were seeing from among their own ranks. What's it like on the floor? What are you seeing? And it's, again, their comments are all consistent with what I was saying and what was on the previous slide. Somebody said, I have clients saying to me, I've had 16 people sign this contract and you're telling me you're not going to. And I say, well, I don't care how many people sign it. If it's not right, why should we sign? You can push back on these things. Again, it's easier said than done, but you're not fighting the good fight on your own. You are having exactly the same arguments with exactly the same people who will try to convince you that you're the only stone in his shoe, when it really isn't true. That's a sort of similar point again, different wording. We always respond at the clarification stage, or actually with our bid, that we will not sign up to indemnities. Indemnities are particularly dangerous for reasons Kevin probably explained earlier, and if not, then I'll happily go into it in questions. I feel like I'm battling upstream. We've walked away from jobs, which is often a good thing, of course. Or the minute we threaten to walk away, remarkably, the indemnity clause isn't required. Another one says, our biggest frustration as a business is negotiating contracts with people who have no idea what they're asking for. It's true though, isn't it? Quite often your client doesn't really know what they're looking for or why they're looking for it. So it is important to push back where you can. I think there are decent clients out there, and if they understand why amendments are being sought, and if you're willing to engage with them for long enough, then they might just be willing to change. I've stuck to 20 minutes, and finally, just to show that we do practice what we preach, there's a page of disclaimers there to say that you're not entitled to rely on anything I've told you as amounting to advice in any way. And that's me done. Thank you.